and get an introduction started for you while you're doing that. And Ellie is a real estate investor who owns over 2,000 units across the U.S., valued at over $250 million. She is the founder and CEO of Blue Lake Capital, a real estate investing firm specializing in multifamily investments, and she helps investors grow their wealth and get double-digit returns by investing alongside her in large multifamily deals. Ellie, I'm going to have you go ahead and take over and take the stage. And as we're going through the presentation today, if you guys have questions, feel free to put them into the Q&A box. And towards the end, we'll all come back on here with you, Ellie, and tee up some of those questions. But if you would like to answer some of them along the way, you can. But if you want to just hold them all to the end, we can do that as well.
Sure, absolutely. So let me see how I can share my screen with you.
Yeah, on the Zoom bar, there should be a green button that says share.
Oh, yeah, I see it. Okay.
And it'll just have you select which screen on the computer. If you have like two screens, you have to select the proper one.
Mm-hmm. Yeah, I see it right now. And I think it should work now. Let me know if you're able to see my screen.
Not yet.
Okay, let me try again. I actually don't see the share button for some reason. Oh, I see it here.
Okay. Sometimes it hides away. Kind of have to hover somehow. There you go.
All right, so you can all see my screen. Let me make it a little bit nicer.
There we go.
All right, can you see it?
Yep, we can see it now. That's great.
All right, perfect. So, hey everybody, welcome to Creative Ways to Invest in Real Estate. I'm Ellie Perlman, as then mentioned, and what I'm going to cover in I think 45 or 60 minutes that we have is talk about kind of my background a little bit, then discuss the creative ways that you have as passive investors and invest in real estate and be part of the real estate game. So just a little bit about me. I'm originally from Israel. I'm 36. Well, actually, I'm 37. I just turned 37 a few weeks ago. And I'm the founder and CEO of Blue Lake Capital. I started actually my career as a real estate lawyer back in Israel, then moved to property management, and then decided to move to the U.S. I went to MIT, got my MBA degree, and then moved to California about 2.5 years ago. And I own about 2,000 units with my husband, Ben. So basically the last deal that we did was on Florida. Some of the units we have been owning as limited partners, and then made the switch to a general partner. So I have the ability to look at deals from both LP, which is limited partners, passive investors, through their eyes, and also through a syndicator's eye. So for those who don't know, a syndication is basically a way to group a bunch of investors together, and they all put the down payment for a property, and this way purchase together a property that usually is anywhere between $5 and $50 million. So before I started going into creative ways to invest in real estate, just wanted to kind of make a note about the fact that I love thinking outside of the box. I like doing things a bit differently, and there's always opportunities where there are challenges for other people. So someone's challenge is a potential opportunity for someone else to step in and provide some value. And this is exactly where the creative ways to invest in real estate, that's basically where it gets. So during the presentation, I'm going to cover the main 3 ways you can creatively invest in real estate. In addition, of course, to participate in any syndication. And with each of those ways, I'm going to cover the pain point that someone has, the opportunity, and also things that you should be aware of, that you should basically take into consideration when you're doing that. So the first way is basically to lend your balance sheet. So the sponsor, this is basically the syndicator, their problem is that they don't have they don't have net worth that is significant enough to make an offer. So what happens is that whenever a sponsor, a real estate investor, a syndicator, whenever they're looking into properties, especially when they just start, owners and brokers don't know who they are, and they need to establish some track record. So many times they're asked to provide some balance sheet, and it's called basically proof of funds to show that they have enough money to make the purchase. That's part of verifying who the potential buyer is. And when someone just starts, so for young syndicators, they don't have enough money to show, they don't have strong balance sheet to show that they can actually make the purchase. So the opportunity is to provide the sponsor with your balance sheet, and you can do that by showing, by sharing some information, of bank statement, or have someone, or have your CPA write a letter, basically saying that they confirm that you have a certain amount in net worth. And that's basically, the opportunity. So yeah, you will, if you're doing that, you will be working with new and many times inexperienced sponsors. But on the other hand, you have no obligation whatsoever. This is something that bears no risk because you're not obligated to purchase anything. You're not obligated to sign on anything. And it's basically a way to lend someone your balance sheet. Usually, so I know someone who's done that in the past, and basically he didn't have enough money, and he basically said, I'm going to pay you about $7,000. I don't remember if it was for $7,000 if I close the deal, if you will be willing to share your balance sheet information with me. And so that's a way to make a little bit more, a little bit money on the side without basically taking actually taking no risk, because you're just sharing your information. You should feel comfortable sharing that, and never do anything you're not comfortable with. But that's one way of partnering in a way, or helping new sponsors get their foot in the door by lending your balance sheet. And when I'm going to finish talking about the 3 creative ways to invest in real estate, or part of the real estate game, I'm going to also share where you can find those opportunities. And basically, lending your balance sheet, I basically started from the least risky option, and I'm going to leave the riskiest of all of those options until the end. So Dan, I don't know if there are any questions or anything before I move to the next, opportunity to invest in real estate.
No, you can. There's no questions in here right now, but I don't know if is there a way to adjust your audio just a little bit, because it sounds like there might be a little bit of crackling in it. I'm not sure if it's just the microphone or if maybe there's a setting you can adjust.
I'm not sure. Let me see. I want to try and close.
We can hear you just fine. It just has a little bit of a crack. I didn't know if there was something you can adjust there.
Okay. Going to try and talk a little bit closer to the mic. Hopefully that's going to help.
Okay.
All right. And so after lending your balance sheet, the second option is to be the bank. So some sponsors don't have enough money to pay for a deposit or for due diligence expenses. And I'll elaborate a little bit about what I mean by that. Usually there's what many investors don't know is that there are a lot of upfront costs that sponsors need to pay out of pocket before they even close the deal. So the first one can be a deposit, and in order today, or it's called hard money. It's not hard money lending, but what it means is that in many hot markets, you cannot even get your offer seriously to be considered if you're not willing to put hard money deposit in. Hard money deposit means that if I'm buying a property, I'm basically saying from day one, or from 10 days or 7 days after we sign on the purchase agreement, I'm going to put in 100 all the way to $500,000 that are going to be deposit on the, so it's basically the first payment for the property. And sometimes it's hard, which means if for any reason, with some exceptions, I'm not going to close, then I'm not eligible to get my money back. And so this is basically the deposit. And in addition, you have due diligence expenses. So when it comes to that, sponsors need to pay to lawyers. They need to pay for due diligence expenses, to walk the properties and have all the reports come back. And so there's a lot of expenses that are upfront before they see anything. Before they actually get paid as part of the acquisitions fee. And this is supposed to basically pay for those upfront expenses. But some sponsors don't have the liquidity to pay for those expenses. And here, this is where you can come in. So the opportunity is to lend money for the deposit or for due diligence expenses. And you can lend this money to sponsors and either get a fixed fee, or this is where it gets more interesting, in my opinion, get basically a piece of the equity. So if sponsors need to put, if a sponsor, let's say, there's a deal and they need to put $250,000 and write this check to the seller in order to get the deal, sometimes they don't have that much money liquid. So if I, as a passive investor, if I have this money liquid and I can play around with it, I can lend this money, basically write the $250,000 check to the sponsor, and in return, I can get 1, 2, 3% of the equity in return. The things to be, so the main risk when you are the bank and lending money for upfront costs is that you basically can, the risk is that if they're not going to close on the deal, you're basically going to be left with maybe nothing because you're not sure that you're actually going to see your money back. So a clever way to do that is to secure your loan with a note. And this is something that is, it's not overly complicated. You're basically saying, okay, if you want $250,000 out of my money, you should write me a note. And this way, you're basically making sure that you are going to get your money back in case that, you know, the deal's not gonna work out and the sponsor is not going to be able to pay your money back. So this would be in the bank. I would say the risk is, I would say, medium risk, because there's an option that, of course, you're not going to see the money, or, you know, you're risking basically that the sponsor will not be able to pay you back. And then the third option, and this is the riskiest out of all, but also the most lucrative one, is to be a basically the guarantor of the loan, and we call it a KP. So KP is the key principal. And the problem is, whenever a sponsor purchases a deal, they need, if they're taking a loan, the lender wants to see that somebody signs on the loan that has the net worth that is equal to the loan amount. So if someone wants to take a $5 million loan, the lender's not going to give them the loan unless they have net worth that is equal to $5 million. There's also some liquidity requirements for 9 to 12 months of debt payments. And so that's a problem. So many sponsors don't have that net worth. And this is where, you know, you get to basically explore this opportunity and sign on the loan as a key principal. And for that, I would say I've seen usually about 5% of the equity of the GP. I've seen some cases with 20 and even more, 20% equity. But this 20% is pretty, it's not common. And it's usually when the sponsors are really struggling last minute, something happened with their KP. This is by far the riskiest option, of course, because you're signing on a huge loan. But I would say the two things to be aware of is A, signing on anything that is a recourse loan, that could be risky. So most loans are non-recourse loans. And when it comes to non-recourse, it means that the collateral is the property. And so if for some reason the sponsors cannot pay back the loan, the bank cannot go to you, to your other assets as the person who signed and guaranteed the loan, because it's a non-recourse. However, there's a bad boy carve out, which means that in two instances they actually can do that. One, if there's a fraud, and B, if the sponsor managed the property in a very negligent way. So if the bank can prove one of those two things, then basically the non-recourse protection is canceled, and the loan is basically turning into a recourse loan. Which of course they'll have to prove it in court, and it's not as that easy, but there's a risk there. And that's why this is the most rewarding option to passively invest in real estate in a creative way, which gives you a significant portion of the GP as part of the equity. So this is, kind of in very high level, the three creative ways to invest in real estate. The first one was providing proof of funds, basically lending your net worth. The other one is be the bank, so you can lend your money for the upfront costs. And then the last one is becoming a KP, a key principal, and signing on the loan. So if there are any questions, let me see. I'm looking at the questions now. I'm sorry. I see that there's audio. The audio is a bit spotty. I hope it's better. I'm not sure what else I can do about that. But if there's any questions, I'm happy to answer them.
So if you have any questions for Ellie, please feel free to open the Q&A box and add them into the Q&A box there. And Ellie, thank you so much for coming in and providing some information here for us. What would you say for somebody who's listening right now that might be curious as to some of the easiest ways to be able to get into this space, how they could get started?
So I would say the easiest way to do that is network with syndicators. The main three ways that I mentioned as creative ways to invest in real estate, you can basically, those opportunities arise where you're going to network with sponsors that are just starting off, or they're still involved in one of their first acquisitions. And so going to places where they are, mainly to events that teach people how to raise capital, how to become syndicators. This is where you're going to see a lot of syndicators that are interested in basically started syndicating, but they don't have enough of a net worth or the right experience so they can actually go and close huge deals. And this is where you can step in. Also, besides conferences and events where they would show up, you can actually, one of the platforms that I really like networking and meeting new people is Bigger Pockets, and I'm not affiliated with them in any way, but you can definitely see people who ask questions, and based on that you can search by there's some keywords you can search, and then when people there's some sponsors there and they're sharing their pain points, and so that's a great way to reach out and communicate and contact sponsors. And once you start talking to some of them, they'll introduce you to others, and it's kind of a network that once you're in, it's going to grow in a fantastic way, and you're going to see opportunities coming your way, because then you're going to hear about a sponsor that is raising capital for a deal, and all of a sudden their KP, something happened with it last minute, and we all know those stories. And this is where opportunities can arise for you to basically step in and invest in real estate in a non-conventional way.
Yeah, and for somebody who say is looking, they have the balance sheet to provide, they have that net worth and liquidity, and they're not sure, how much they might need for each deal, but they have, a significant net worth. What would you say would be like the minimum net worth someone might want to have in order to really provide that major benefit to a group that's looking for some sort of a balance sheet guarantor? And then how would that person go about finding a group or a sponsorship to actually be a part of, to actually have them use them to take advantage of that creative way?
I would say anything, I mean, even $1 million of net worth can be useful for some sponsors. The most of the deals that I see around me they require between $3 to $10 million in net worth and above that. So I would say anywhere between 3 to 5, especially 5 and above. And then the second part of your question was, where can they actually see those opportunities? You can listen to podcasts, and besides going to conferences and events and network with people, you can start listening to podcasts and start listening to sponsors and investors that are there as guest speakers, and you can reach out to them, chat with them, see if you like them, see if you trust them, get on their mailing list. So every time they have a deal, you can hear about it. And then, offer, and this is something that we also do, because besides being a syndicator, I'm also looking for KP opportunities. And so with other sponsors, so I'm on the mailing list of my, of sponsors from all across the US and with different levels of experience. And basically, whenever that happens and I see someone that I like and someone I want to do business with, we sometimes offer, hey, do you have a KP? And sometimes, more often than not, the answer is no, or yes, we do, but we're unsure if that's going to work. So this is something that, this is a great way to get on sponsors' mailing list, to be able to see who has deals and who, might need someone to help them out with the upfront costs for signing on the loan as a KP. Now, I have a question here. I don't know if you want me to.
Sure, go ahead.
Yeah, so I have a question from Jeffrey Berlin. What are your favorite markets from a regional basis? So it's not entirely directly related to the topic we're talking about, but I can briefly mention that when I'm looking at markets, I'm looking at 4 factors. I'm looking at job growth, population growth, and rent growth. And in addition, and I would like to see them higher than the national average. And in addition, I'm looking for states that are landlord friendly, which is why right now I'm not investing in California, unfortunately. We had a huge scare of Prop 10, which almost passed, which is going to make the entire Ellie region rent controlled, and they're trying to pass it again. So that would kill any value add deal. And so that's basically the markets that we're focused on. Those who answer those markets and those criteria in Texas, Florida, and Georgia. But this is how we choose markets, and these are favorite markets. And I do the same when I'm looking at a deal as well, to be a KP or to lend someone the deposit money. We're looking into the fundamentals of the market to assess whether that could be a decent deal and a decent market.
So another question here is coming from Denise, and she says, a little off topic, but I'm going to kind of spin her question a little bit so you can answer her question, but maybe from a different angle. And she's asking, do you recommend that LPs invest as an individual or form a corporate entity to invest? And so the way I want to spin this is have you answer that question from the passive investor standpoint as an LP, but also from a standpoint of that balance sheet guarantor or somebody who's going to join the GP, how should they invest on the GP side as well?
Excellent question. So from an LP point of view, I'll say my investors, it's kind of half and half. And some invest as individuals and some invest through an LLC. It's a pass-through entity, so it doesn't provide a lot of tax benefits. But I'm not an expert when it comes to taxes, so it's definitely something you should ask your CPA. When it comes to basically becoming on the GP side as an LP by lending, money for due diligence, if that was the question, if I understood it correctly. I personally prefer to have a separate LLC with its own expenses. It's a little bit more organized this way. It doesn't provide me with a lot of value in terms of more tax benefits, but I like to keep it separate so it's very clear the expenses and the income that comes through that entity. And I like to do that for each deal individually. So by the end of the year, when we're looking into different deals and different opportunities, we're able to see how much money we've made from each of them. And it's just easier to track. It doesn't cost a lot of money to establish those LLCs, less than $200 depending on the state. It's a little bit more money, when it comes to bookkeeping and doing the tax returns, but not significantly. So it's a matter of, I think, of a personal choice. But I would say if it's a little bit more complicated than just writing a check as an LP, when you're more involved on the GP side, I would like to have the LLC, which also should serve as a layer of protection. So if something happens with the GP and the GP is being sued, you have some protection because you're basically coming in as an LLC.
Yes, that's a good answer there. That's kind of very similar to how we do things, and we also do. I'm not sure what state you register your LLCs in, but we usually do a Wyoming LLC for ours. Yeah,
good. Yeah. It's a state that it's pretty much easy to do it. To open companies online with the registrar, the costs are pretty low, and they have really good laws when it comes to partnerships. What happens if one partner, God forbid, dies, or if something happens? So they're very pro-business and pro-partnerships. So it's just easy to do it this way.
Yeah, absolutely. Well, there's no other questions that are coming in right now, Ellie, but I want to thank you so much for your time and providing some of those creative ways to be able to get into the multifamily investing space. And looking forward to continue to follow you, and looking forward for you to come back for the next summit coming up in January 2020. So make sure you mark your calendar there.
Absolutely. Thank you so much, Dan. It was great being here.
You as well.